Right now, XRP is trading more than 60% below its summer 2025 peak. For 46 consecutive days, retail market sentiment has been paralyzed in extreme fear, sitting at an abysmal 11 out of 100. Factor in today's 2.7% intraday dip, and day traders are flooding message boards with claims that the asset is in a death spiral. But look at the actual capital flow. While the public is panic selling their holdings at a loss, large financial entities are buying up that exact supply and quietly locking it away. Firms with trillions in assets under management, like Franklin Templeton, have established regulated investment products for the asset, positioning themselves to absorb tokens as retail participants exit their positions. We are watching a transfer of tokens from retail hands into regulated institutional vaults. If you only look at the red on the daily price ticker, you completely miss the structural accumulation driving the real market. This vertical bar chart plots institutional demand against retail selling. Notice these 9 straight days of positive inflows into XRP ETFs, pushing assets to $1.28 billion. Fund mandates remove 1% of circulating supply monthly, pushing available XRP on exchanges to 7-year lows. While the supply shrinks, the underlying network is expanding. The XRP ledger just crossed an all-time high of 8.18 million total active addresses, and the composition of those addresses is shifting. For the first time since September, millionaire wallets, accounts holding over 1 million tokens, are growing in number rather than distributing their coins. They are holding because the network offers genuine utility. There are now 28,000 automated market maker pools providing on-chain liquidity, supported by over $1 billion locked in the Ripple USD stablecoin. Liquid supply on the open market is rapidly evaporating, exactly as high-value enterprise network usage reaches new all-time highs. When we map that $1.28 billion of institutional accumulation onto the technical charts, the recent price compression reflects this underlying demand. This price chart forms a double bottom pattern. Twice, the price dropped to $1.25, hitting an institutional buy wall. Now, Bollinger Bands wrap the price to measure volatility. Notice their severe contraction, squeezing tightly around the sideways movement. Historically, when volatility squeezes this tightly on the daily and 12-hour charts, the mathematical probability of a violent 15 to 20% directional breakout increases significantly. Retail day traders look at this sideways chart and see a stagnant asset. In reality, it is a heavily compressed spring waiting for a catalyst. That catalyst is currently sitting in the U.S. Senate. It's called the Clarity Act, and it is scheduled for a pivotal vote this April. This legislation is designed to officially classify the asset as a digital commodity, removing the last remaining regulatory ceiling that has kept traditional finance from full participation. This regulatory framework would allow Tier 1 global banks like HSBC and BNY Mellon to integrate the token directly into their liquidity management and treasury operations. When the volatility squeeze resolves, the immediate hurdle is the $1.35 resistance pivot. If the price blows past that line, the structural target sits between $1.60 and 65 cents. That zone aligns perfectly with historical Fibonacci retracement levels. In financial markets, wealth transfers occur when participants learn to ignore retail panic and track exactly where the institutions are placing